Are you ready? Welcome back to today's video, and today's video is over chapter 5. In the first 4 chapters, all of our companies that we worked with were service companies where they just provided a service. The difference of chapter 5 is dealing with merchandising companies, and as you know, merchandising companies actually carry a physical inventory. So our primary emphasis in this chapter and in these chapter 5 videos is going to be over the journal entries, the unique journal entries for a merchandising company. As you probably know, there's 2 types of merchandising companies. There's retailers. We're all familiar with retailers because we all shop. And then there is wholesalers, and wholesalers can sell to any number of people. They sell to other businesses, or they may sell to retailers. So let's get started right away with our first example problem. And on this video, we're going to deal with sales, where we are making the sales. So starting off here, back to Kid Company, it says on September 4th, Kid Company sold merchandise that had cost $1,500. In other words, it cost us $1,500. We sold it for $2,800 under credit terms of $115 net 60 FOB shipping point. All right, a couple things to point out here. First off, credit terms. We do not have to offer credit terms. As you probably know, credit terms are where we are saying, okay, go ahead and take the merchandise, pay us later. In this case, they have to pay us by at least 60 days. If our customer pays us within 15 days, though, they get a 1% discount. That's what the 115 represents. And then if they don't pay us within the 15 days, the net 60 means that it's due in 60 days. Actually, those are pretty liberal terms, aren't they? That's probably not real common where 60-day terms are offered. And then the other item here is FOB shipping point. When we sell merchandise, we've got to make sure we know who pays the freight. Is it going to be us, the seller, or is it going to be the customer? Well, the seller always creates the invoices. So the shipping terms always read from the seller's perspective. So when it says shipping point, that means us, in this case, the seller, will get the goods to the shipping point, which is basically the dock of our warehouse. So who pays the freight? In this case, when it says FOB shipping point, that means the buyer pays the freight, not the seller. If the terms were FOB destination, that means that the seller is responsible for getting the goods to their ultimate destination, which is the customer. Okay, so we made a sale here. We actually have 2 journal entries we need to make. One, we need to make the journal entry for the $2,800 sale, and then we need a second journal entry to record the fact that we have $1,500 less merchandise because we just sold it. We just sent it out to the customer. So looking at the next slide here, you can see the 2 journal entries we make. The first one there, we debit accounts receivable $2,800 because the customer does indeed owe us $2,800, and then we credit sales, or sales revenue. In the first 4 chapters, we were calling that something like fees earned or some type of a revenue account. Same thing, sales, you could tack on sales revenue there if that makes it a little clearer to you. Then the second journal entry records cost of goods sold. We had a cost of $1,500 regarding merchandise to make this sale. Cost of goods sold is an expense account. It goes on the income statement. So just because it doesn't end in expense, don't think it's not an expense. It is indeed an expense and goes on the income statement. And then we credit merchandise inventory because we no longer have that $1,500 worth of merchandise inventory. So we need to take that out of our inventory, take it out of our assets, reduce our assets by $1,500. So we'll make that journal entry there, or those 2 journal entries, every time we make a sale. Next issue we've got is that we issued a $100 credit memorandum for goods returned from the September 4 sale. So apparently our customer got the wrong color, the wrong goods, whatever it may be, damaged maybe, and we said that we would accept the $100 return. So we did indeed accept the $100 return, and as you see on our next slide, we need to make another journal entry for the $100 memorandum. Anytime we accept a return, and again, you always need to know where you're making the journal entry, from which side, as the buyer and the seller. In this case, we are the seller. and we've just accepted a $100 return. So when we do that, anytime we accept a return, we're going to debit sales returns and allowances for $100. That's a new account. We credit accounts receivable for $100 because that customer no longer owes us that money, do they? Now, the sales returns and allowance account, that is a contra sales account. Just by intuition, can't you see that our sales are reduced by $100 when we accept a return? But we want to keep track of our returns. So, we could just as easily just debit sales for the $100, but then we wouldn't have a record of the total amount of returns. So instead, we're going to reduce sales through this contra sales account, sales returns and allowance. All right, the next issue is on September 16th, we received full payment from the September 4th sale. Take a second and maybe put me on pause and see if you can figure out how much does that customer owe us to pay this thing off in full. As a business owner, anytime a customer says, hey, what do I owe you? You want to be able to tell them right away because you want your money. And so calculate what this customer owes us. All right, going to the next slide, we can see our calculation here. And you can see the discount is the $2,800 minus the $100 return. We're not going to give them a discount on returned goods. So we subtract out the $100 return. Take it times 1%. The terms were 115 net 60. Well, this customer is paying within the 15-day discount period, so they get their 1% discount. So the discount comes out to, as you can see, $27. Now we need to make a journal entry, assuming we received the cash. Let's see, by some quick math, what would that be? Did we receive $2,773, I believe? $2,673. See, I almost forgot about the return also. And so the amount of cash we're going to receive is the $2,800 minus the $100 return. That's $2,700 minus the $27 discount. I believe that's $2,673. So as you can see on the next slide, we make our journal entry, $2,663. My math is still off, isn't it? $2,663. Now that's not right. We've got a typo here, don't we? It should be $2,673. My math was correct originally. $2,700 minus $27 is $2,673. Okay, so this is an obvious case where our debits and credits don't add up, do they? They don't add up. We know our debits and credits should always equal, but they don't here. So we're going to debit sales discount for $27. We're going to debit cash for $2,673. Assume the customer's check really was for $2,673, and then we're going to credit accounts receivable for $2,700. So see, you need to pay attention to these slides here because you never know when I'm going to slip in a mistake here, right? Okay, I hope this helped. The next video is where we are on the other side. We are purchasing the inventory.